It's Mike Lynch with AmeriFirst Financial. It's time for your Monday morning mortgage update for the week of October the 3rd. It's the first week in October. Hope you had a great end of September weekend. I had a packed weekend. Had a date night with my daughter. Went to a party for an old sheriff, Jim Pope. Saw a lot of friends that I haven't seen in a while. Rode my road bike 50 miles. Got from a 50-mile point. Really haven't done that in a while because it's been so hot out, but great ride. And ended the week going on a dinner cruise with the family. Went out to Whiskey Town, just a shot of the sunset. Just beautiful out there. Actually put sweaters on and had some blankets. It was so nice and cool out there. All right, so let's talk about what happened in the market last week and what's going to happen this week. Oh my gosh, talk about volatility in the market over the last week and a half. It's been crazy. It's so hard to keep up with it, but let's kind of rewind and go back to not last Wednesday, but the Wednesday before. And I'm putting my cursor on that date. It was the 21st of September. And this is, just to review, a representation of the bond market where mortgage-backed securities are traded. And each one of these bars here is 1 day of trading, the ups or the downs. If you see a green, that means money's flowing into the bond market and mortgage rates are getting better, going down. If you see a red, money's flowing out of the bond market and mortgage rates are going up, getting worse. So on the 21st, we know what happened. The Federal Reserve raised the Fed fund rate 0.75%. Now, that did not impact mortgage rates. It was already baked in that these rates were going to increase, and they baked that pricing in, that expectation the Fed was going to do this a week, 2 weeks before that. So you can see as I put my cursor on the 21st, there was hardly any movement on that day as far as pricing and rates. But my gosh, look what happened the next day. Over 100 basis points sell-off in the bond market on that Thursday following that. And that was because the United Kingdom, UK, Britain said, hey, we got a big problem. We are going to increase our Fed fund rate. We got a big recession. They said they're going to give tax cuts to the rich. And we're in a world economy and everybody freaked out. Big sell-off in the bond market. Mortgage rates went up. Friday, kind of leveled off. And then Monday, 154 basis point sell-off in the bond market. Now, to put that in perspective, to see 100 basis point sell-off movement in the bond market in 1 week is not very common, but to see it in 1 day is very rare. Again, this all had to do with the UK recession numbers. Energy costs are expected to go way up in Europe next year. Just a lot of bad numbers came out of Europe. And then what happened? We had a big recovery. All those losses that we lost on Monday, on Wednesday, we got them back. And then the market went down again on Thursday and Friday. And then today it's back up. It's back up over 100 basis points. I mean, I don't know how we keep track of this stuff. The rates are up, they're down, they're up, they're down. What I do know is we can't control these rates. We can't control what the market's going to do. All we can control is how we interpret it and what we tell our buyers and our sellers, because they're getting, every day they turn on the news or get on the internet, they're seeing up and down and up and down, and it just creates fear and uncertainty. So we have to be that solid voice for our buyers and sellers. But let's talk about what's happening in the market this week and how it's going to impact rates. So 3 things, I always give you 3 things that are going to impact the market: jobs, world politics, and some stuff at home. Some numbers and stats are coming out at home. So big jobs week happens every month, and a lot of jobs numbers are coming out: wages, unemployment numbers, jobless claims, all that stuff. And last month, the job numbers actually showed the economy was slowing a little bit. However, indicators have implied that maybe it's growing. So there's been this push and pull. So we really want to see where the jobs are this week for the month. Are we seeing fewer jobs? Are we going to start seeing more of a slowing economy? And that'll impact rates. Obviously, as the economy worsens or struggles, that's better for mortgage rates. World politics. So last week, as I said, the United Kingdom and all their financial reports just caused a lot of turmoil and uncertainty in the market, a lot of volatility. And they said they were going to hike rates, their equivalent of the Fed fund rate, and they said they were going to give a tax cut to the rich. They created so much havoc that then they said, okay, now we're going to buy mortgage bonds or their equivalent of mortgage bonds. And then today said, okay, we're not going to do the tax cut to the rich. I mean, they're just all over the place. And the reason the market actually improved today is because UK's backed off on some of their policies that created so much turmoil. The other thing that happened is going to happen this week is OPEC has announced to cut oil production. OPEC, as we know, is the largest producer of oil, and that's going to drive up energy costs. If they do this, that means that we're going to see increased energy costs going into the winter, increased fuel, oil, heating oil, things like that. And then the third thing is at home. Big manufacturing numbers coming out. So it's something called an ISM manufacturing and services report. Basically, it shows the change in production levels. What are businesses ordering? Are they seeing a demand for those raw materials? Are they ordering more stuff? Are they cutting back on what they're ordering? And so their survey, they survey a lot of manufacturing managers at big companies. And what are those managers doing? Are they ordering more or are they backing off? It's a key measure of the state of our U.S. economy. Last week, some similar manufacturing numbers that came out were really bad, showing our economy is weakening. And so if we see a weakening economy, that is actually better for mortgage rates, not good for the economy. But then what does it do for inflation? So inflation we know is bad for rates. A weakening economy is good for rates. So again, there's just this push and pull. There's just so much volatility. So what are we doing? We're starting the day actually locking because the market is up over 100 basis points. So we're seeing if we could ride this wave and maybe get some better pricing moving forward. But knowing that these job numbers are starting to come out tomorrow, Wednesday, and Friday, we're on a really fast trigger finger to lock rates if we see the market move. So if you have any questions about rates, if clients do, don't hesitate to give me a call. All my contact information is below. If you know somebody can benefit from this video, I would appreciate if you forward it to them. Have an awesome day, and we'll talk to you soon. Bye-bye.